Joining us for the first time, thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dmitry Pogomonic. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Perfect.
Let me share my screen here. So the show, if you guys are joining us for the first time, it's really to answer any questions you guys may have about the Market Chameleon tools, data analytics. If you have questions, you can put the questions in on the live chat on YouTube. Will's watching it. He'll read it back to me. If you want to come on a show and ask your question live, we also provide a link to Zoom. Click on that link, takes you over to Zoom. Once you get into Zoom, there's a button, raise your hand. Click on that. You don't have to turn on your video camera. Once we let you in, you will be live, everybody can hear you, and you could ask your question direct. While we're waiting for questions to come in, we'll start out with the pre-market report. We did a webinar yesterday with Interactive Brokers. A couple people asked questions about some stocks they wanted to look at and trade ideas on the calendar spread. So maybe we'll take a look at that while we're waiting for questions to come in. If you do get questions, Will, let me know. I'll stop and take those questions first.
All right, perfect.
Okay, let's start out with the pre-market report. These are stocks trading in pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. Down here, I see 22 stocks made our percentage gainers list, 28 on the decliners. From that perspective, it looks like a neutral open. There's no overwhelming bullish or bearish bias. Let's filter out this list to only S&P 500 companies. We want to remove small cap stocks, leverage products, ETFs, closed-end funds, all that. Take them out and get a glimpse of what's going on in the S&P 500. To do that, I'm going to use the filters above. This one in ETF, when I drop it down, I have a list of ETFs to select from. The top one, SPY, we're going to select that. That's the S&P 500 ETF. When you do that, let's go ahead and do that. When you do that, the list below will get filtered by stocks that are holdings in that ETF. SPY, that's the S&P 500 ETF. We could see here, these are the stocks that are constituents of the S&P 500. Here we see 5 stocks made our percentage gainers list, 7 on the decliners. That looks like a very modest or neutral bias at the open, maybe a slightly bearish. Let's take a look if you have no questions at the, and of course today, big day, we have the Fed announcement that's coming up at 2 o'clock. We also have Powell, I think, speaking a half hour after that, around 2:30. We're going to get some insights what the Fed is seeing, what they're projecting into the future. So that will be an important today. Keep an eye out for that. If you have no questions, well, then I will go maybe to the alerts in the homepage. Maybe find a stock somebody asked questions about yesterday during our webinar and take a look at a calendar spread.
Yeah, actually, Rob and Mike both watched the webinar yesterday, and both are looking forward, actually, they said, to your look at the calendar spreads.
Okay, awesome. Let's take a look at what was the stock. What were the stocks that we had up yesterday? If people wanted to,
I think the vote was between Netflix, SPY, and Tesla, and I think we looked at Tesla, right? Tesla had
Okay.
more votes.
All right. We looked at, let's take a look at Netflix. I'm going to type it in here. This is going to bring me up the alerts for Netflix. And I have to go back a couple here. There's a calendar spread here. These were yesterday's alerts that I could scroll through. But the one over here at 3:37, there was an alert for calendar spread. We'll take a look at that one. Was it Netflix that we looked at yesterday or Tesla? This one looks familiar to me.
Maybe it was Netflix was the one who voted yes, and maybe it was Tesla we needed to look at, and SPY. I know SPY was one that we needed to look at, but if that looks familiar,
let's take a look at SPY. All right, a couple alerts here. We're getting SPY is going ex-dividend. That's important coming up this week. If you guys have options that are in the money, call options in the money, and they could be an early exercise. You could see that dividend, it's a pretty big dividend. Keep that in mind. Let me see here if I could go back. A lot of alerts coming up between then. Is this a calendar spread? Okay, let's take a look at SPY. I'm sorry, that's what spread? Here's a calendar spread. Let's take a look at SPY calendar spread. And here we had a alert for a bearish calendar put spread in SPY yesterday at 3:36. And here are the details of it. There's two legs to a calendar spread. We talked about this yesterday. You're selling one option in a nearer term expiration, and then you're buying an option with the same strike, same option type with the same strike, but in a longer dated expiration. This one here shows us that January 13th, 2013, there are 21 days to expiration, selling the 400 put, and then going out to January 27th, 2023, buying the 400 put, that's 30 days to expiration, right? About a week apart over here. And now let's take a look at the highlights. And after we take a look at the highlights, we'll analyze it from the options chain. So you can see here, these are the strategy highlights. The market price for this spread, remember, you're buying the outer, selling the near term, is $1.50 debit. That's the cost of it. Our analysis of that spread, going back into history, looking at a relationship between similar strikes. So it's really looking at a horizontal skew or a skew between two options that have similar days to expiration and similar days apart. Okay. The average value of that spread historically was $1.76. So we convert everything to today's theoretical values, $1.76. That gives us, if we compare the market price versus its historical benchmark, a 15% discount. Now, of course, we don't know if the spread will pay off or not until, actually everything plays out. The idea here is that you're getting something of a little bit extra for taking on a risk. Without knowing what's going to happen, we have no idea where the stock's going to be, where the implied vols are going to be. But here we see that according to the benchmark that we're measured, we're getting a little bit of something of a little bit extra based on that historical relationship between these two options. Then the next metric is, well, what do we think the potential profit is given a favorable outcome in the stock, right? So we'll put that up in the options profit calculator payout diagram, but the most favorable outcome is that on this expiration, January 13th, the stock goes right to our strike here, 400. Why? Because this option will expire worthless. So whatever we sold this option for, if it expires worthless, we keep that credit. And then this option here on January 13th, you could see that it still has time to go because this doesn't expire till January 27th, right?
PD?
Yep.
Robert just typed in, and we're on a delay, so sorry about this. He says, my alerts does not have the little window to select a symbol. Is that new? Will we get it soon?
Wait, you sure you don't have this? Hold on a second.
I'm assuming he's referring to the alerts by symbol in the right corner.
I thought you guys have it.
Rob, will you send a screenshot to us what you're seeing? Other people, if they don't have that alert, just let us know. You can let me know in the chat.
Okay, that might, if that's on my internal. Let me see if I could push out that feature. So you don't have that alert. Let me see if we're still testing it. Just email me as a reminder, Rob, and I'm gonna check with our developers if we're still testing something with that feature.
If Rob said it is that
testing, you don't have it. All right,
that's what Rob's saying. Correct.
All right, just send me an email reminder, Rob. I'm going to check with our developers if that's something we could push out. If we can, I'm going to make sure that we'll push it out our next publish. So our next publish with feature enhancements, I'll push it out. So we do a few publishes a week, and so I'll try to get that out there.
Perfect.
Yep. So let's come back down over here to the calendar spread. And before I showed to you in a diagram, you could see here.
Hey, B,
yeah.
Just a heads up, we have a and thanks for joining. We have a new person in the chat who came over from the IBKR webinar yesterday.
Oh, cool.
And he said also he doesn't have the default on the left hand either in his.
Yeah, so this default, that I know it's my internal. This will not be available to you guys right now because I test new alerts. So they come in here and I could test it. The reason you guys don't have this is because we change it up a lot as we are fixing alerts, or sometimes we have to take alerts and refine them or merge them. And the reason you guys don't have it is that I do need it to do my testing on, but I think you have something in there where it's either manage my alerts. Do you guys have something like manage my alerts or alert type where you could turn on and off? But at this point, at sometime in the future, we'll have a version of this. But at this time, we don't, because, I don't want it to be jarring to you guys if we're changing it a lot, especially, we're going to rename some of these alerts because sometimes we merge two alerts into one. Okay, and then we have to give it a different name. So you're not going to see this. Keep in mind when we do this show, also I always use my internal version because that's what I'm used to, and my internal version includes features you guys don't have yet because it's also where I test the new features out, and a lot of these you will not have because they're still in test mode. And we do it in test mode because sometimes we bring in new data And whenever we bring in new data from different vendors, we start looking at the data, we find exceptions, we find things that are weird, that sometimes we have to go back to the data vendor and they need to fix things that we find. Other times we clean the data up ourselves. Once we get it, we take out data. We do our own cleaning process. Okay, so when we do that, and then we develop the features and work out the bugs, I have that on my internal version. You're not going to get to see that yet until the feature is ready to get pushed out to you. And when we push out that feature out to you, it may even look different than on my test environment, because in my test environment, we don't always think about the design for the end user as much as being able to test out the feature and the data and so forth. So you will see things here on my version you're not going to see on yours. All right. So let's get back to this one, SPY. But with this alert, I'm gonna see if I could push this one out. All right, because I'm not currently testing it, and I don't remember if there was any issues with it. So this one I might be able to push out. But send me an email reminder. All right, on the calendar spread, bearish calendar spread, we could see we want what do we really want in this spread? Well, if we're selling an option, we want that option to expire worthless, so we could just keep any premium that we sold it for. That's our best case scenario. At the same time, this strategy involves buying an option. And for this option, well, we want it to be worth as much as possible, because if you're buying something, right, you want it to go to the moon. And then this scenario to play out, we want the stock itself to hit this 400, right? Because if it goes lower, then this option will be in the money. If it's higher than 400, then this will expire worthless. It's great. But since we own this option, we want the stock to go down as much as possible. So 400 is the sweet spot. Okay. 400, the strike price is the sweet spot. And if this option expires worthless, the next thing is at 400, it's all time premium, right? It'll be at the money. So it's all time premium. And we want the time premium to be as high as possible, which if the implied volatility goes higher, time premium goes higher. That's the scenario we want ideally. All right. Now, to calculate this profit potential, what we're doing is saying the following. If on January 13th, SPY pins at 400 and these expire worthless, we'll keep that, whatever we sold it for. But then we have to estimate this option. What will it be worth? Because it'll still have 9 more days to go. What will it be worth? What we do is look at it at our data bank, into our database, and say, historically, what is the median implied volatility for an option in SPY that's at the money with 9 days left to expiration? So remember, this will have 9 days left to expiration instead of 30 on that. And then we use that median implied volatility to calculate what this spread will be worth relative to what we paid for it. And then we say that the profit potential is 279%. Okay, so that's how we get here. And this gives you a kind of estimate. Well, what am I risking for potentially what can I possibly make? And it could be higher or lower, right? It could even be higher than 279. That's not your max, because if implied volatility is higher than the 50th percentile, then this will go up. If it's lower, it's lower. But we're putting it right at the 50th percentile. And it gives you an idea, is this a good enough profit potential, to take that risk if you have that out. Okay, and I think the way the alerts work is it will not alert you unless the profit potential is at least a double, at least 100%. Okay, that's when the alerts kick in, and I think this has to be at least 15%, I believe. All right, for any alert, we do have thresholds. On a valuation basis, we could see this was at the time of alert, this was the market in the spread, $1.40, $1.50. We used $1.50 as the price, which would be at that moment the worst price, right? If you bought it at the market. But the idea is you always want to try to do better than that. We showed the midpoint $1.45. $1.45, it would be considered the fair market value at that moment, right? The fair market value is the midpoint of that, what the market, the best bid in the market, and the best offer at the market at the moment. So somewhere in between would be the fair market value, $1.45. If you could get it at $1.45, that's great. If you could get it under, that's even better. But that does play a big part in the overall potential profit. We're not dealing, it's only, this option spread is only $1.50, 5 cents, right? That's going to play whatever it is, couple percentages, but that adds up over time. Keep that in mind. Those are the execution costs. We also have the average value of the spread. Now we could take a look at the high and low to see historically how it bounced around, and this gives you a range, a high of 357, a low of 83. And the idea there is the following, that when it's a high range, it's more historically more risky, more volatile, right? If the average was 176 and the high was 177, low 175, well, we know that that average is pretty steady. This gives us a range, and we could see it is pretty wide, from 176, right? And right here, the good part, I guess, from the perspective of buying it is that to the high, there's more room to the high than to the low. Okay. If you wanted to read a little bit more about it, kind of shows you the premise behind this trade. Now let's click on it and see how this trade sets up in the options chain in SPY. And what this will do when you click on it, it's going to bring down below the options chain. This is SPY. You have the options chain with all the different expirations. These are all the different so it'll default, I think, it's going to default to the first expiration of the nearest term in this leg, January 13th. And you could set up strategies right from the options chain by clicking on the bids and offers, but this will automatically populate that strategy for you. The first leg, selling January 13th, 400 put for, let me see, $9.10. Okay, so $9.10 right here, 400 put. And then it goes out for you January 27th expiration. Let's go over here, January 27th expiration, and it looks for the 400 put over here and finds it $10.59. Okay. Of course, you could change the ratios here, the strikes, but this auto populates for you what it sees in the options chain. And then I'm going to hit calculate, and this will draw us a profit and loss or payout diagram for this strategy using the first expiration, January 13th. We talked about this yesterday. The reason we use January 13th is that after January 13th, the first leg of this option spread expires. After that, you no longer have a time spread. Okay, that the time spread will cease to exist. You still do own this option, but this strategy will not exist any longer. The first option will either expire worthless or it'll be at the money and get converted to stock, but you no longer have a time spread. That's the last day that this spread will exist. We use January 13th as the expiration to calculate the payout diagram. Now, the problem with this payout diagram is we don't know what the implied volatility will be on this second option. And that's where we have to estimate. This diagram here is just going to use the same assumption. Implied volatility is at the same level as it is today. But that's not really realistic because we know implied volatility does move, right? It does move as it gets closer to expiration. And what we'll do is go over here into the IBKR. I'm going to pull out this payout diagram. And this payout diagram gives us a little bit of a better picture by using historical data. And says, okay, on January 13th, what we know is that the first option will expire. We know that the second option will have 9 days left to expiration. If we look at SPY options historically with 9 days left to expiration and use the 50th percentile rank implied volatility, what does the payout diagram look like? So it'll look like this. And you can see your sweet spot here is 400. The profit, if it's at 400, right at that spot, and implied volatility is in the 50th percentile rank, which basically is in the middle of where it usually trades, then the profit will be $335. Okay, so what do we say? You're spending $150 to make $335 in this scenario. So you could see here that, if that happens, that's a sweet return. Now we could actually move it around and say, what if we're wrong and implied volatility comes in to the 30th percentile? Okay, it'll be on the low end. Basically, it'll be subdued. I'm going to reload that chart. And if it goes to 400 and the implied volatility is in the 30th percentile, that's still a $224 return, on $150. So it's risk. So it's, your 150 plus $224 profit. So you could see that still is better 2-to-1 return. Okay. Again, if that hits that 400 spot, but you could see where this, let me see here. If the stock moves a lot, you're losing 150, 150 what you paid basically for that spread if it moves a lot.
Hey, D.
Right up, yeah.
Bob, who is a new user, just asked, why don't you use the same expiration? I know the answer. I just figured you'd tell him.
I'm not sure what you mean by the same.
Well, you were doing a time spread, right? This was a
right.
Time
So this is
yeah.
a time spread, right? What the same expiration would be a different strategy. That would be a vertical spread. You can use the same expiration, but then you no longer call it a calendar spread. You would call it, a vertical bull put spread, bear put spread, and you have that as well. So using the same expiration here's a same expiration, right? Yeah, here's a same expiration.
An analysis for picking the time spread could be a lot of variables, right? You're taking advantage of maybe of volatility, something you see between the 2 months, correct?
Right. So a calendar spread would be, part of it is the skew between different expirations. Within the same expiration, like this one, December 15th, December 15th, what comes into play is the skew between different strike prices. Okay, that's what that would be the difference. and in an analysis, you're analyzing different things. We did a webinar on calendar spreads yesterday. That's why we kind of came over today. We still had some leftover questions, but we could do it within the same expiration. Within the same expiration, you have also a different risk profile. Of course, then you have your delta risk, your vega risk is different, your delta risk is different, gamma risk. So there's still a different risk profile, but yes, within the same expiration, here's one within the same expiration. I'll just show you here. And you could see it populated these legs, December 15th. And you see how the payout diagram looks different, right? This is a put spread. So now your outlook is you profit from a different set of circumstances where, here, if the stock falls into anywhere in this range, it's profitable. Anywhere in this range, it's unprofitable. Again, different outlook, different set of circumstances, different risk profile within that same expiration.
All right. Awesome job, my friend. We're 2 minutes into the opening. Great job as always. Thanks for doing it, D.
Yep. Thanks everyone for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
Trade in peace, Chameleon.